this short video, we will discuss the m-squared ratio, how the m-squared ratio is used, what the m-cubed ratio is, as well as the advantages and disadvantages of using these metrics. The m-squared ratio was developed by Franco Modigliani and his granddaughter Leah in 1997 as an extension of the Sharpe ratio to create risk-adjusted portfolios by using risk-free assets to lever or delever an active manager's portfolio. The m-squared ratio allows the portfolios to be compared simply by looking at the resulting returns. The fund with the highest m-squared ratio will have the highest return for a given amount of risk. When the m-squared ratio is used, investors' measure of risk is the tracking error as opposed to relative risk divided by volatility. Modigliani made an important contribution by showing that a portfolio and the benchmark must have the same risk to compare them in terms of basis points of risk-adjusted performance. They define risk as the volatility or standard deviation of a portfolio's return. The M2 measure is nothing more than a positive linear transformation of the Sharpe ratio. The portfolio rankings based on the Sharpe ratio or the M2 will always be the same. The M2 measure does not contain more or different information than the Sharpe ratio. It is simply a more user-friendly formulation of the same concept. In essence, for a fund with any given risk and return, the M2 measure is equivalent to the return the fund would have achieved if it had the same risk as the market index. Thus, the fund with the highest M2 measure, like the fund with the highest Sharpe ratio, would be the highest return given any level of risk. The m-cubed ratio is an extension of the m-squared ratio, and it gives an investor allocation information as to allocate cash, the benchmark, and the potential active strategy. The m-cubed ratio calculation would give the same result as an m-squared ratio, but the target tracking error is not present. The M3 measure recognizes that the investor has to consider basis points of risk-adjusted performance after ensuring that correlations of various funds versus the benchmark are also equal. In effect, all tracking errors are normalized to the same value. The measures of the M2 and M3 are expressed in percentage points. It can be more easily understood by average investors than comparing it to the Sharpe ratio or the Trainer ratio. One major shortcoming is that the two investment strategies normalized for benchmark volatility could have different correlations with the benchmarks and hence different tracking errors.